Welcome to Financial Insights in Minutes, where we summarize the top real estate market videos from the day. Today, we're diving deep into housing market trends, risks, and potential opportunities. Is the economy on the brink of disaster? We'll explore alarming unemployment rates and what they mean for housing investments.
Plus, we'll see how falling mortgage rates could be a silver lining for buyers.
Stick around as we dissect expert opinions and strategies around this critical topic.
It's essential for investors and homeowners to stay alert in these times.
Reventure Consulting warns of a market crash due to rising unemployment levels. Mallah offers tips to acquire luxury cars via savvy real estate investments. Ken McElroy explains how population dynamics affect real estate success. Lance Lambert discusses the indicators leading to a potential housing market crash. Ralph McLean reveals how falling mortgage rates may create new investing opportunities. Jason Walter covers the recent drop in mortgage rates and its impact on buyers. Dave Meyer provides guidance on small multifamily real estate investments. Welcome to Reventure Consulting on YouTube. Today, we're diving into alarming signs in the economy. Unemployment rates approaching recession levels. Our esteemed guest, Nick Gurley, is here to break it down.
That's right. Nick has been shining a light on significant economic trends, and it sounds like we need to be paying attention. Hold on to your hats, folks.
So, what's the big takeaway from Nick's insights?
The main thesis is clear. Rising unemployment and other economic indicators suggest we're on the brink of a market crash, with serious implications for stocks and housing.
Let's dive into those key points. Starting with unemployment, what's going on there?
Absolutely. Unemployment has surged to 4.3%, up from just 3.3%. That's over 7 million people out of work, and that's a staggering 21% increase year over year.
And how does this relate to the stock market?
The S&P 500 is trading at over 30 times earnings, comparable to the bubbles we saw in 2000 and 2021. Talk about a red flag.
So what's the impact of these job losses on spending?
When people lose their jobs, consumer spending drops. And that's exactly what we're seeing. Major companies like McDonald's and Amazon are warning about weakening demand.
Let's not forget the housing market. What are the indicators there?
The housing inventory has skyrocketed by 400% in certain areas, and with high homeowner equity, many are poised to offer significant price reductions.
Now, what predictions does Nick make about the upcoming year?
He predicts severe impacts for the most overvalued markets, a likely decline in both real estate and stock prices as the economy contracts.
And how should investors prepare for this storm?
Nick suggests holding cash. Treasury bills are a safe bet right now, paying over 5%, and they'll allow investors to be flexible when the market dips.
To sum it up, what should we walk away with today?
Prepare for significant shifts in the market due to rising unemployment. Establishing a cash reserve could allow you to capitalize on upcoming opportunities in real estate and beyond.
Welcome to another episode on Ben Mallah's YouTube channel. Today's exciting topic, how to snag a supercar without paying full price. Buckle up, folks.
That's right. Ben dives into practical strategies that can help anyone leverage their money smartly. And with his real estate expertise, he's got quite the perspective.
So, what's the main thesis of today's video?
The key takeaway is simple. Invest wisely in real estate or REITs and use the returns to cover the costs of luxury items like supercars.
Let's get into those key points Ben discussed.
First up, investing in distressed properties builds wealth. Ben emphasizes, the harder you work on these, the more you make.
And what about financing those flashy cars?
Ben shares a brilliant strategy. Take your investment returns to cover the monthly payment and insurance, making the dream car feel less like a financial burden.
Smart spending is crucial. What does Ben suggest here?
He highlights finding low-interest deals and understanding the resale value of luxury cars. It's about making the car work for you.
Any crystal ball predictions for the luxury car market?
Ben forecasts a rise in long-term rentals and more interest in low-interest financing options. The landscape is changing.
So, what's the bottom line from today's adventure?
Ben sums it up by underscoring the importance of smart investments in real estate to afford luxury cars. A mindset of cleaning up distressed assets can lead to immense rewards.
Welcome to Ken McElroy's YouTube channel. Today, Let's navigate through the turbulent waters of real estate market predictions. With over 35 years in the multifamily business, Ken will share key insights into where your real estate market might be heading in the next 12 months.
Absolutely. Ken dives into the critical role of population dynamics and market migrations that underpin real estate success. It's a treasure trove of information for investors at every level.
So, what key message should we walk away with from Ken's discussion?
The crux of Ken's thesis is simple. Real estate relies heavily on people. Without residents, demand for rentals or homes evaporates. Understanding migration trends is critical for real estate success.
Let's get into the key points Ken highlighted, starting with population trends. What's happening there?
Right now, the U.S. population is projected to reach 341 million. But regions like Detroit have plummeted from 1.8 million in the 1950s to just 650,000 today, a staggering loss.
What did Ken say about migration patterns?
Ken emphasized that regions experiencing population influx see increased rental demand. By tracking census data, you can pinpoint where residents are settling and where they're leaving.
What about the building constraints he mentioned?
With interest rates rising, new construction is stalling. This, combined with limited housing starts, puts pressure on rental markets, keeping prices volatile.
How do homeownership rates factor into Ken's analysis?
Currently, homeownership rates are at 63%, the lowest in years. Many people are shifting back to renting due to economic pressures. This trend heavily influences real estate markets.
What are some of Ken's predictions moving forward?
Ken anticipates continued migration will drive rental demand, especially in secondary markets. He strongly urges investors to pay attention to these trends.
Any predictions on construction in the housing sector?
Yes, Ken predicts ongoing delays in new construction due to rising costs, which will negatively affect housing supply. Expect this to create more competition in rental markets.
To wrap things up, what are the overarching takeaways?
The key takeaway is clear. Successful real estate investing hinges on understanding population dynamics and migration patterns. For anyone thinking about investing, this insight is absolutely crucial.
Any final thoughts regarding investor strategies?
Yes, investors need to stay vigilant about market trends and patterns of migration. It's not just about numbers, it's about people and where they choose to live.
Welcome back to Real Estate Mindset. Today's topic dives into the housing market data and leading indicators. Joining us is the astute Lance Lambert, a journalist well-versed in housing analysis. Let's explore what's brewing in the housing market.
Absolutely. Lance brings a wealth of knowledge and stunning visual data to the table. As he lays out the complexities of the market, viewers will gain crucial insights into their home buying decisions.
So what's the main argument here? Is there a potential flash crash on the horizon?
Indeed. The core thesis revolves around the current indicators and market conditions pointing towards significant correction, if not an outright crash in the housing market.
Let's get into the nitty-gritty. Could you define the difference between a market crash and correction for our viewers?
Certainly. A crash is more severe, typically a drop of 20% or more, while a correction can simply mean a decline of 5 to 15%. Currently, places like Punta Gorda have seen around a 9% drop already.
Now, what should buyers watch for as indicators in their local markets?
Great question. Key indicators include rising active inventory, increasing price cuts, and longer days on market. All of these signal a cooling off period in various market sectors.
And what about regional differences in the housing market?
Absolutely. Different areas react unpredictably, with the Southwest and Gulf showing signs of weakness, while some Midwest markets stay resilient.
Affordability seems to be a major factor. How does its strain influence the market?
Affordability pressures can lead to reduced buyer activity and increased delinquency rates, which may not yet be fully captured by major data providers.
What can we expect in terms of future market conditions?
Expect potential corrections if new listings increase due to delinquency rates rising further. A clear signal could lead to price declines across affected markets.
To wrap it up, what final advice do you have for viewers worried about the housing market?
Stay alert and informed. Understanding local market conditions, indicators, and the broader picture will be crucial in making smart decisions in this volatile environment.
Welcome to Bigger Pockets. Today's hot topic are falling mortgage rates paving a way for investors. Joining us is Ralph McLean, a seasoned economist from Realtor.com, ready to help us decode the latest housing market trends.
Absolutely. Ralph brings over 20 years of experience in housing economics, focusing on market analytics and supply trends. Grab your life jackets, folks, because we're diving deep.
So what's the core thesis of Ralph's insights? What shifts can we expect?
The main takeaway is that mortgage rates are starting to decline, which could signal a more favorable environment for investors in the housing market as we approach 2024.
Let's navigate through Ralph's key points. What's happening with mortgage rates?
Ralph highlights that the Fed's focus on managing inflation, currently at 2%, could lead to a gradual decrease in mortgage rates. No express elevators here. It's all about the stairs.
What's the scoop on inventory levels then?
With inventory spiking by 35 to 40% year over year, homes are sitting on average for 45 days. Sellers are feeling the heat. About 20% are now cutting prices.
And what should we anticipate for the market outlook?
The national market is returning to a state of equilibrium post-pandemic, where mid and lower-tier homes are garnering more attention due to the current economic climate.
Now, let's peek into Ralph's crystal ball. What are his predictions?
He predicts a steady decline in mortgage rates, and with increased inventory, potential growth opportunities for investors will be on the table.
What about regional differences?
The South and West are thriving with new supply, while the Midwest and Northeast are still wrestling with low inventory levels.
So, what's the takeaway for future investors?
Ralph suggests that now may be the time to act on investment opportunities. As the market is normalizing and inventory levels are favorable, it's time to seize the moment.
What does Ralph recommend overall?
His closing advice? Avoid getting caught up in sensational headlines. Instead, focus on the fundamental shifts that point to a healthier housing market. And that's great news for savvy investors.
Welcome to the channel. Today, we're navigating through some fascinating waters, the plunge in mortgage rates following the latest Fed announcement.
Absolutely. This drop might be the silver lining buyers have been waiting for. With a real estate expert at the helm, we're in for an insightful journey.
Let's get straight to the facts. What's the core message from today's video?
The thesis is clear. Mortgage rates have dipped to a 7-month low, driven by a surge in jobless claims and hints from the Fed about a potential interest rate cut in September.
What's the scoop on jobless claims then?
Initial claims jumped to 249,000. That's the highest since August of last year, signaling potential stress in the labor market.
And how about those mortgage rates?
They've hit 6.62%, down from 7.10% last year. That's the lowest since December 2022.
Increased purchasing power. How impactful are those rate changes?
With the drop in rates, buyers can see a 14% boost in purchasing power. Meanwhile, home prices have only risen by 9%.
What's on the horizon for future rate cuts?
The probability for a 25 basis point cut in September is at 79.5%. The forecast suggests 3 such cuts by the end of the year.
So what can we expect in terms of market movement?
Expect more buyers to enter the market with these lower rates. Inventory has also increased by 35% compared to last year.
What's the final takeaway for potential buyers?
While declining mortgage rates open doors, buyers should be strategic and prepared for a long-term commitment. Timing the market can be tricky.
And any parting wisdom for our viewers?
Look at the numbers, plan for the long haul, and don't get swept away by market fluctuations. It's about making informed decisions.
Welcome to Bigger Pockets. Today's topic is all about small multifamily real estate investing. Our expert guide, Dave Meyer, has more than 14 years of experience under his belt.
Absolutely. Dave shares invaluable tips and insights to help aspiring investors achieve financial freedom. Buckle up, it's going to be a fun ride.
So what's the main message from Dave's webinar?
The core thesis is that investing in small multifamily properties, duplexes, triplexes, and fourplexes provides a manageable pathway to achieving financial independence and a sustainable income.
Dave outlines a seamless 3-step process for potential investors. Can you break that down for us?
Absolutely. Step 1, find deals. Step 2, analyze them. And step 3, secure financing. It's surprisingly straightforward.
What are some common hurdles new investors face?
The biggest hurdles include fear of not having enough money, worrying about losing everything on a risky deal, and the daunting task of securing financing.
What makes small multifamily properties such a catch?
They are inherently designed for cash flow and come with tools like residential financing, which lightens the entry barriers and reduces competition. It's a win-win.
Any predictions about the future of small multifamilies in real estate?
Definitely. More investors will catch on to their potential, which could lead to increased opportunities and activity in this segment of the market.
Before we wrap up, what are the main takeaways?
The ultimate message is clear. Investing one property at a time can pave your way toward financial freedom. Overcoming initial fears and leveraging the right tools is crucial for long-term success.
Today's discussions revealed critical insights. We started with Reventure Consulting, warning us about a potential market crash linked to rising unemployment.
Then Mallah encouraged us to think creatively about funding luxury assets through real estate.
Kevin McElroy highlighted the importance of understanding regional population movements.
While Lance Lambert predicted a market correction, Ralph McLean pointed out the bright side of falling mortgage rates.
In the end, balancing risk and opportunity is crucial for savvy investors navigating today's housing market. Thanks for watching Financial Insights in Minutes for August 3rd, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.